Welcome to Phillip Futures Market Watch. My name is Joyce Liu, Investment Analyst with Phillip Futures. On 30th January, the Federal Open Market Committee (FOMC) announced that existing monetary easing policies will stay put, and spot gold rallied close to 1%. The next day, it reversed all the gains. How have Federal Reserve stimulus plans affected gold prices thus far? And going forward, where are gold prices headed? Let us look back at history, starting with the financial crisis. The financial crisis hit the US in late 2007 and peaked in September 2008, accelerated by the colossal fall of Lehman Brothers due to its failed mortgage-backed securities. By then, fear of excessive exposure to the housing market had penetrated the financial system. Credit liquidity froze, banks stopped lending, companies could not operate normally and stopped investing. Consumers stopped spending, and we had a recession. The first measure that the US government dished out to stimulate the economy was to lower interest rates. By doing so, the objective is to discourage consumer saving and encourage corporate borrowing at low interest rates so that consumers spend and corporates invest, thereby stimulating growth in the economy. Since December 2008, interest rates have been kept at a record low range of 0 to 0.25%. However, with the interest rates at such record lows, with little room to fall further, consumer spending remained slumped, and unemployment continued on its rise. Inflation rose above interest rate, and real interest rate became negative. Record low interest rates have failed to stimulate economic growth. So Federal Reserve resorted to injecting money into the economy by buying mortgage-backed securities and treasuries. Since December 2008, there have been 4 rounds of quantitative easing, during which money supply jumped significantly. The first from December 2008 to March 2010, the second from November 2010 to June 2011, and the third and fourth as recent as September and December last year. Yet, during the same period, real GDP in the US recorded negative growth, and only in 2012 did it manage to par 2007 levels of GDP. Where did all the extra money go to? The money went to paper assets such as stocks and gold. From their crisis low in March 2008, the S&P 500 and Dow Jones Industrial Average more than doubled to hit above 1,500 and 14,000 respectively. These are historically boom time levels reached before the 2011 dot-com crash and before the 2007 financial crash. But the US economy has barely trudged out of its shadows now in 2013. So if the earning prospects of companies have not improved significantly, what has caused the magnificent gains? The only satisfying explanation is, instead of encouraging spending and investments, the $2.5 trillion pumped into the economy had mostly gone into paper assets. This is manifested even more obviously in gold prices. From its low of 620 in October 2008, gold prices steadily rose throughout the economic gloom to reach an all-time high of 1,920 in September 2011. Almost tripling the asset value in less than 3 years. The magnified rise in gold is a result of its safe haven asset status, and its subsequent drop in value can also be attributed to a reduction in need for such safe haven assets, as signs of an improving economy started to show in early 2012. So if QE money flowing into paper assets and gold's appeal as a safe haven asset has been driving gold prices to the recent highs, what is the outlook of gold in view of these two factors? Let's take a look at the figures. Real US gross domestic private investment is on its recovery trajectory, and so is real US personal consumption expenditure. GDP contracted 0.1% in fourth quarter 2012, but is mostly a result of defense expenditure cuts and economic damage from Hurricane Sandy, both of which are temporary. In addition, the Purchasing Manager Index, a leading economic indicator, jumped well above the critical 50 mark to 53.1, and non-farm payrolls added another 157,000 jobs in January. We are inclined to believe that the US economy is on track for recovery. We foresee some money flowing out of gold and other paper assets into private investments by the end of this quarter. Furthermore, we expect gold to slowly lose its appeal as a safe haven asset as the US economy trudges out of its crisis mode. Turning to the charts, we believe gold will once again test the strong support level of 1,550, and if it breaks through, may send gold tumbling to the next support level at 1,420. For more information on the risks and returns of investing in gold and gold futures, please approach any representative from Phillip Futures for further discussion. My name is Joyce Liu, Investment Analyst with Phillip Futures. Thank you, and please stay tuned for more Market Watch videos.